Despite the recent relief rally, Bitcoin's price action is undeniably weak right now, and there's no point dressing that up. We've had a decent bounce off the late March lows, but zoom out slightly and the reality becomes obvious. From the October 2025 all-time high at $126,000 down to today's $78,000, we're sitting on a roughly 38% drawdown. And that's the headline number most people are focused on, and understandably so. It's what grabs attention and it's what drives engagement. But that's not really the point of this video, because while price action tells you what's happening in the short term, it doesn't tell you what actually matters. The more important question is, where is Bitcoin relative to its own long-term trajectory? And to answer that, we need to look at something far more fundamental than recent price action. On this chart, what stands out isn't the recent drop. It's this white line running through the entire structure. And at first glance, especially on these shorter time frames, it might look like just another trend line cutting through the recent price action that I've randomly drawn on, but it couldn't be further from the truth. And when you zoom all the way out, this line spans Bitcoin's entire price history going back to 2010. And what it represents is one of the most important concepts that you can understand in this market, which is the logarithmic growth line. And this line acts as kind of like a fundamental fair value baseline for Bitcoin. It's not based on short-term speculation or market sentiment. Instead, it's derived from two underlying mathematical forces that are constantly interacting with each other. The first is the power curve, and this represents the exponential adoption of the Bitcoin network over time. As more users, more capital, and more infrastructure come into the system, the network grows in a compounding way. And that's what gives Bitcoin its long-term upward trajectory. And on a logarithmic chart, this exponential growth appears smooth and structured, which is why the line looks so clean. And the second force is the logarithmic price axis itself. If you plotted Bitcoin on a linear scale, the early years would look almost invisible, and the curve right now would look completely absurd, because Bitcoin has grown faster than the internet adoption in the late 1990s. So the logarithmic scale compresses those early exponential gains into something that can actually be visualized and analyzed properly. But there's another critical component here, and that's the time decay. Every single day, a small mathematical decay factor is applied to the model, and this reflects a very real concept, and we call it the law of diminishing returns, because physics applies to finance sometimes. Early in Bitcoin's life, when it was a tiny asset, it didn't take much capital at all to move the price significantly. A few $1 million could generate a massive 10x return. But today, Bitcoin is a $1 trillion asset, and moving it requires a completely different scale of capital. Instead of the small resale flows, you now need institutional level demand to drive significant price increases. And that's why the curve gradually flattens over time. Not because Bitcoin is weakening, but because it's maturing. And that's critical here. A flattening curve is not a bearish signal. It's a mathematical signature of an asset that's transitioning from a high growth, high vol asset into something that's more stable and structurally embedded within the global financial system. And Bitcoin is still growing and it's still outperforming nearly every traditional asset, but the nature of that growth is definitely evolving. Now, another way to visualize this same concept is something known as the power law. And at first glance, it kind of looks like a completely different model with its straight line running cleanly through Bitcoin's price history. But in reality, it's actually another representation of the same underlying dynamics. The difference is actually in how the axes are scaled. In the power law model, both the price axis and the time axis are logarithmic. And that's why the later years appear compressed as you move closer to the present. And this dual log scaling actually transforms the curve growth line into a straight line like you can see here. And it makes it easier to analyze the long-term trend. And the reason this works comes down to two key factors. First, the natural decay and volatility over time, like we said. And second, the compounding effect of network adoption. These two forces combine to create a structure that follows pretty much a perfect power law distribution, and something that isn't unique to Bitcoin either. You see patterns like this come across in all different natural systems, from earthquakes to river networks to distributions of stars and galaxies. But while the power law model is elegant, it's not something to just rely on blindly. And I'm somewhat power law agnostic, if that's even a term. But it does provide a useful framework for thinking about long-term positioning, and that's exactly how I like to use it. And right now it's telling us something quite important. The fair value based on this model is sitting at around $100,000. And this projection is based on some rigorous mathematics of the last 15 years of data. So with Bitcoin currently floating around the $78,000 mark, that puts us roughly 22% below the long-term adoption trend. And that's not the most extreme deviation level that we've ever seen, but it's also not expensive either. It sits in that middle ground where the asset is undervalued relative to its long-term trend, but not at the point where you sell your house just to get a piece of it. Now, to make this even clearer, we can look at one of my favourite charts, which is the power law drawdown. And this strips things back to something very simple. When price moves below the long-term power law trend line, you start to see these yellow and red zones appear on the chart. And these represent the periods where Bitcoin is trading at a discount relative to its fundamental growth curve. And historically, the deepest bear markets, like in 2015 and 2022, saw drawdowns of between 40 to 50% roughly below this trend line. And those periods marked some of the best buying opportunities in Bitcoin's history. They were extremely uncomfortable times, and most Bitcoiners were either capitulating themselves or completely disengaged. But structurally, those were the moments where long-term value was being created. And right now, we're sitting at around a 22% deviation, so firmly in the yellow to orange territory. And that is meaningful, but again, it's not extreme. It suggests that we're in a zone where accumulating more sats through dollar cost averaging does kind of make sense. And if you want to see every chart that I use, including the ones that I'm using today, then go check them all out at onchainmind.io. Now, if you want to frame this model in terms of risk, then we can look at something quite aptly called the logarithmic risk model. And this, as you might have guessed, takes the same underlying concept and expresses it as a risk oscillator. And this might be more intuitive for many of you to interpret. So instead of focusing on price levels, it shows how far Bitcoin is deviating from its long-term adoption trend. And here it's pretty straightforward. Warmer colours, like the deeper reds, indicate periods of elevated risk, typically associated with market tops or the more euphoric phases of the market. And the cooler colours, like the lighter yellows, indicate lower risk environments, at least in terms of Bitcoin's long-term adoption trend. And this is only one input making up this risk oscillator, so it's not exactly the most complex, but you can see it's effectively captured the peaks and troughs of Bitcoin's entire price history incredibly accurately, even as the asset has skyrocketed from a few dollars in 2011 all the way to where it currently sits today. And at this moment, the risk level is sitting at around 33%. And for context, the 50% reading aligns with the power law fair value line, which, as we said, is around $100,000 at the moment. So on the downside, the lower bound of the risk model, where we'd essentially be in the first percentile of Bitcoin network adoption risk, is currently sitting at around $46,000. Now, for context, we rarely get below 20% on this metric, and that's by design on purpose. This tool here isn't about calling the exact tops or bottoms to the day or to the exact price wick. It's about framing where we are in the overall adoption cycle of this amazing asset and asking a very big question of, should I be DCAing at these levels, or should I hold off at this moment? And while I like to use this channel for the most part to deep dive into the weeds of the data and unpack some of the most powerful on-chain dynamics shaping the recent price action, every now and then it's worth doing something far more simpler and something we often forget to do, which is zoom out. And when we do zoom out, from a big picture perspective, Bitcoin is clearly below its long-term adoption trend, but not dramatically so. It's in a phase that, for me, is still firmly in dollar cost averaging territory. Because structurally, nothing has broken. The long-term growth curve still remains intact. The network continues to expand at a pace even faster than the early days of the internet. And the mathematical framework that has governed Bitcoin's behavior over the past 15 years is still holding strong. Price has rallied again, sure, but it wouldn't be unusual to see it roll over again and test lower levels. But that doesn't really change anything for me. Bitcoin has a habit of shaking people out in both directions, and it certainly doesn't reward short-term reactions. It rewards alignment with its long-term structure. And right now, that structure is still pointing in one direction. So anyway, I hope you all found this useful. And as always, I'll catch you in the next one.